Hello friends, how are you doing out there? I hope the market's treating you well and you are trading through the volatility of the markets fairly efficiently after having watched these videos. And also note how for 26 weeks our levels for the Nifty and the Bank Nifty have held fairly well. Only on 1 week was there a minor exceeding of these limits, but for 25 weeks we've held the ball and called the ball right. So in that same tradition, we continue this week, and in this weekly video, I discuss what happened to the market and what you can expect in the coming week as well. Last weekend, I advocated that the impetus, the study that I introduced to you 3 weeks ago, and most of these studies are not available anywhere in the public domain. These are in-house studies by our statistical model, the Barracuda. I said the impetus was falling while the price itself on the Nifty and the Bank Nifty was under pressure, which meant that the selling was likely to ease. And guess what? Even though the week was a short one, we had 2 holidays out there, the Nifty and the Bank Nifty managed to rise on 2 sessions out of 3. So in addition to being careful, I told you that we'll let the price tell us where it wants to go, and the price basically told us that it wanted to go higher. Now the market roundup screen graphic on your screen tells you that last week was an exceptional one because there was no loser at all. Currencies, commodities, equities, indices, forex, everything seemed to have gone up last week. Now that itself is a rare phenomena, but it happened. Now this will come as no surprise to my viewers that the Nifty rose more than the Bank Nifty, and by now you know that the key lies in bond yields, the Dixie, and inflation. We've spoken about these in many weekly videos in the past. Bullion saw a pullback rally as the government data showed that there was a 4-fold increase in recent imports of bullion in India thanks to falling prices and the fear of falling interest rates. Indians seem to have bought more gold. And oil and gas also rose after the OPEC meeting announced that there would come a staggered hike in output in phases of 3.5 lakh barrels, 3.5 lakh barrels, and 4.5 lakh barrels over the coming 3 months starting from May. And of course, there will be another meeting in a couple of weeks to take a fresh call. And since there was no immediate hike in the output and the dollar basically declined on the last trading session of the week, oil and gas prices rose. This was partly responsible for the Nifty and the Bank Nifty not rising as much as it could have because rising oil prices kept pressure on the indices. The Dixie continued to rally, and the upside was basically capped in the emerging markets, including India, by a unusually strong dollar. We typically want a weak dollar because we are import dependent nations and everything that we import becomes more expensive if the dollar remains firm. So coming up on your screen is the MWPL, or the market wide position limits chart. And you will see that the MWPL is rising steadily, which is a routine phenomena after the expiry. And once the March future series expired, a lot of positions were allowed to basically die out, and the traders are now building up fresh exposure, which is a routine matter after the new settlement starts. Now the chart of the index, stock, and cumulative futures of April, May, and June series. Now index is Nifty and Bank Nifty, and individual stock futures are all stock futures put together, remember, of 3 expiries. This shows that the turnover fell sharply, and this was of course a short trading week, so part of the falling turnover can be attributed to a very, very lazy and truncated, holiday truncated week. We need to watch the volumes pretty carefully, especially if the market is to rise. On a rising market, if the volumes are falling, that's not really a very healthy sign. So keep your ears to the ground and keep watching the traded volumes. Now, these are aspects that I put up on my social media account every day. So do feel free to connect with me on my social media pages and get this data at the end of the day. Now, coming up on your screen is the basis chart. Now, basis is nothing but the premium enjoyed by the futures over the spot. Now, the basis on your screen shows that the Bank Nifty basis rose faster than the Nifty basis because the Bank Nifty witnessed a lot of short covering on declines. And the more there was short covering, the more the bears were forced to buy in a panic even at higher levels, which pushed the basis higher. Now, it is routine to see high basis in the initial part of the derivative series because there are more days left to expiry and it stabilizes lower, the basis stabilizes lower over time. This of course means that even options premium, especially on the call options, will be fairly high now, and as time progresses, there will be a time decay in the options premium along with the basis in the futures series. Take a look at the impetus chart. Now, this is a study which is in-house, not available anywhere in the public domain. The impetus chart shows the Nifty is gaining velocity even as the index inches higher, which means that the Nifty 50 as an index is relatively, I'm using the word relative here, is relatively more promising as compared to the Bank Nifty. The Bank Nifty impetus, on the other hand, fell even as the index attempted to make a floor support for itself. Note that this impetus is with a 20-day look-back period, and as I said, this study measures the velocity or the strength or the speed at which the price and the momentum is rising. So here again there's a divergence. The Nifty on the impetus chart also seems relatively better placed as compared to the Bank Nifty. Now, it is these in-house studies which have basically enabled us over the last 25-26 weeks to accurately project levels of both the Nifty and the Bank Nifty in spite of the high volatility. And we would love to hear from you about what you think about these studies actually. Now, the roundup done, I'm proceeding to an area of the market which saw a huge amount of activity and action, huge amount of news flow also. The bond markets and the fixed income markets. Here, the 10-year benchmark bond yields climbed higher on the week-on-week basis. The RBI bond dealers and the RBI's viewpoint continues to remain at loggerheads opposite to each other. The announcement and thereafter a quick withdrawal of the small saving interest rate cut validates my hypothesis that the RBI wants to cut its borrowing cost and the borrowing cost of the government by extension by cutting interest rates. The bond dealers, on the other hand, are wanting higher interest rates for putting in more money in the government borrowing schemes. Do remember, I've told you in the past that the government needs to borrow 12 lakh crores in this financial year, if not higher. So, the recent announcement by the government that it will front load the borrowing to the extent of 60 to 65% in the first half of the financial year itself is again likely to lead volatility in this market. By front loading, I mean, let me just declutter and de-jargonize this statement for you. By front loading means, front loading by 60-65% means that the government will attempt to borrow 60 to 65% of the 12 lakh crores that it wants to borrow in the first half of the financial year, which means it wants to collect the majority of its targeted money early in the year itself. It's in a hurry to borrow money, which basically raises the probability that interest rates are going to get cut sooner rather than later. And that basically, of course, it seems to me that it's only a matter of time. If bond yields were to rise next week, that will be further confirmation of my viewpoint. And those of my viewers who are very active or allocate a good deal of money in fixed income securities, I would suggest you do well to lock in your investments as far as possible at the existing rates for a minimum period of 12 to 15 months. Of course, beyond that, I do expect market forces to push interest rates higher. But prior to that, don't rule out interest decline. So maybe you want to lock in some coupon rates at the present levels. We'll of course keep visiting this aspect of the market every week and even daily on my social media account. So feel free to connect with me here. The debt market's done. Let's now go to the US dollar index, or affectionately known as the Dixie. Now this currency benchmark continued to rise, but the pace appeared to slacken, especially towards the last two trading sessions of the week. And it is this decline in the last two sessions in the Dixie that led to hard assets or commodities rising, especially oil and gas. And of course, to that extent, even gold and silver rose because the dollar fell in the last 2 days. But take a look at the daily chart. The index remains above its 25-day exponential moving average. And the last two sessions, of course, are showing red candles on the daily chart, which basically tells you that the bulls were slightly under pressure. The 91.60 levels, 91.60, remains a support to watch out for. And now take a look at the weekly chart on your screen. It shows an inverted hammer, which means that some selling was seen on advances on the weekly time frame. The bulls attempted to push this index higher but failed. The bears basically pushed prices lower. Of course, net week on week there were gains, but an irrefutable rally will invariably come only if the previous week's high of 93.47 is overcome on a continuous closing basis. That will basically imbibe confidence in the buyers to buy the Dixie again. On the weekly chart, of course, the price remains above its 25-week exponential moving average, which means that the rally seems to be intact for now. Now, last week I advocated a range between 93.90 on the upside and 91.60 on the downside, which held perfectly well. The coming week can see an estimated, I'm using the word estimated here, range between 94.15, 94.15 on the upside and 91.90 or 91.90 on the downside. Keep watching this space keenly because it will impact both the banking stocks, commodities, as well as the overall equity market sentiments as well. Friends, let's now go to the Bank Nifty, which rose on 2 out of 3 trading sessions, but it still managed to underperform the Nifty 50 on a relative comparative basis. The bulls remain under pressure if the cost of carry of the last 2 series is to be taken into account. Now, this is something which is not really being factored in by many traders. Cost of carry or rollover costs. If you were to actually put in that on a last 2 futures expiry basis, you will see that the bulls are seriously underwater. And coming up on your screen is the daily chart, where the price remains below its 25-day exponential moving average, as well as the bullish trend line. Now that means in the near term, absolute near term, there is short-term pressure on this index. And that is what makes this index relatively weaker than the Nifty itself. Now check out the weekly chart on your screen. The last week's bullish candle is contained within the previous bearish candle, which means this was like a narrower range. Of course, no surprises. It was a short week. And like I said last week, the price remained above its 25 weeks exponential moving average, which means that the longer term trend still remains upwards. And for the Bank Nifty to signal a comfortable buy with a buy and hold kind of a view, the rally must exceed 35,500 levels on a continuous closing basis to rope in bulls to participate in larger numbers. Wait for that before you actually commit large quantities on the buy side. If you're bottom fishing on small numbers for intraday, maybe that's fine. But if you're taking positional bets, wait for 35,500 to be overcome. Now, in the week before last, this index was number 3 on the most volatile list, but last week it fell to number 4. Not because the volatility went down, but because individual stock volatility rose higher in comparison. Now, last week I advocated a range between 35,225 on the upside and 31,425 on the downside, which held perfectly well. And in the coming week, I expect an estimated, I stress upon the word estimated here, range between 35,650 on the upside and 32,050 on the downside. Pure volatility or statistical beta can rise next week, so I think you need to trade light and keep your stop losses diligently. Friends, now let's move to the Nifty 50, the most liquid and the low impact cost traded instrument in the derivative segment on the NSE. This index also rose on 2 out of 3 trading sessions last week and outperformed the Bank Nifty in a relative comparative basis. If you were to see at the daily chart, you will see that this index has climbed above its 25-day exponential moving average, which makes this chart relatively stronger as compared to the Bank Nifty, where the index, remember, on the daily chart was lower than the average. Where the price, however, remains below its near-term trend line, that means the correction is still ongoing. And if you were to now take a look at the weekly chart on screen, the index is still above its 25-week exponential moving average, which means the long-term outlook remains up, which is something that I had pointed out last week as well. Now, if you're a swing trader and you want to take a buy and hold kind of a long position, I think you'll have to wait for a continuous closing above the 15,050, 15050, 15,050 levels on a continuous closing basis and above before you confirm a buy trade. In the week before last, this index was number 8 on the most volatile list, but it fell to number 9 because individual stocks surpassed it in volatility. And last week, I advocated a range between 15,100 on the upside and 13,925 on the downside, which held perfectly well. The coming week is likely to see an estimated, I stress on the word estimated here, range between 15,450 on the upside and 14,300 on the downside. Here again, statistical beta or volatility may remain higher. Therefore, I advocate caution. Trade with small lots. Keep your stop losses. Trade long if you want, no problem. But do keep stop losses diligently. Don't keep your trade without a stop. That is hazardous to your trading health. Friends, the indices is done. I now come to the most popular segment of this video, wherein I'll give you 5 stocks which are high beta, wherein you will take small exposure, wait for larger price moves to make your money, and 5 stocks which are low beta, where you take large exposure and wait for small price moves to make your money. So the high beta, high impetus stocks list is led by Tata Steel at number 1, number 2 Jindal Steel, number 3 Titan Industries, number 4 Asian Paints, and number 5 JSW Steel. Note how the high beta list is dominated by metal stocks and the Tata Group, of course. The low beta, low impetus stock list, where you will take high exposure and wait for smaller price move, is led by Federal Bank at number 1, Number 2 is Petronet LNG. Number 3, Granules India. Number 4, Exide Industries. And number 5, BPCL. Friends, this list is dynamic. Volatility changes from day to day, and therefore the hierarchy of these shares can change on a day-to-day basis. Do keep following me on social media for daily updates late evening as we crunch the data and present it to you in a very simple layman's language of what to expect from the markets. Friends, I hope you like this video, and if you do, please subscribe to my YouTube channel if you haven't already done so. In the comments section, do let me know what you think of this video. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And help me reach out to fellow like-minded investors and traders by recommending my video to your family and friends. On your screen now are my contact coordinates. Please feel free to connect with me. We'll keep conversations going, help each other understand the markets better and become better traders in the bargain. I wish you have a very, very profitable week ahead. Vijay Bhambwani signing off for now. Thank you for watching my videos. Take care. Bye-bye.